Welcome back. You're still watching Finweek Money Matters. Remember, this is the show that helps you manage your finances. South African banking stocks have taken a hammering in recent weeks, and this has been driven by investor uncertainty. Of course, this follows the events, the unexpected axing of former Finance Minister Nhlanhla Nene and concerns over the credit rating downgrade to junk. While globally, financial stocks have also been under pressure due to uncertainty over a slowdown in China and the possibility of a global recession. With local banking shares trading at multi-year low valuations, is this possibly the time to buy? Well, we're going to try and answer this for you. We're joined by Niël Hougaard. He's a fund analyst at Autus Fund Managers. Arno Smit, Chief Investment Officer at Skyblue Fund Managers. They both join us from our Cape Town studio. Gentlemen, thank you so much for your time. Arno, let's pick up with you. We've painted a picture in terms of the pressures that we've seen on the South African front. Globally, though, we've also seen stocks under pressure there. So maybe just paint a picture in terms of factors that have influenced this pressure.
Yeah, I think there's various factors globally that has detracted from banks specifically. And I think the main one, in my opinion, it would be the flattening of the yield curve. So basically what the bank is paying on investments versus what the bank is paying for funding. So that gap is narrowed, which is obviously talking to lower earnings going forward. Then if you add to that negative rates, where banks at this stage is not passing through those negative rates, it becomes a big concern, because then those are actually costing the bank instead of making money on that type of investment. So that's the one factor. The other factor, which I think might be a smaller factor, is the oil price. Banks are heavily exposed to oil projects. So the closing of oil projects should affect their earnings going forward. And then lastly, just the whole commodity cycle, which has turned down dramatically, like we've all seen. So I think those are the big three factors.
Yeah. Niël, let's come back to you. Let's go to you in terms of you explaining if we've seen these factors filter into the South African banking sector, and maybe what's the biggest risk that is facing South African banks at the moment?
Yeah, I mean, I think it's worth noting that from a bottom-up perspective, South African stocks or South African banks have traditionally been financially sound. They've had strong balance sheets, been defensive and known for being great value creators. So I think the issues on the local front has been macro driven, as noted that there's also a growth issue in South Africa, and with the issues happening in December, that's led to further FX weakness, and even our growth forecast being revised down further. So with the effects of rising inflation and interest rates adding to that, I think that has been contributing to our stocks suffering as well. And obviously also the possibility of a sovereign downgrade that's been weighing heavily on the local stocks.
Arno, what should be the strategy that we use here? Obviously, we are waiting to see what the finance minister will say next week regarding the budget, and if this will allay the fears of ratings agencies. Should we wait before we start piling into the banking sector?
Yeah, to me that's a difficult question. If it was a month ago, then it would have been a fairly easy question. We would have been on a multiple for the sector, just a normal historic multiple of 9, which makes the sector at that stage, which was middle January, dirt cheap. Today, the sector has retraced and we're currently sitting on an 11 to 12 multiple, just normal historic PE multiples. So it seems as though a lot of the overreaction has been already priced back or retraced basically. So at this stage I think the focus should be on earnings if you were to invest now. So firstly you need to decide for how long do you want to invest. If it's a 5-year investment like you should do with shares, then I think it's still a proper investment. But if you're going to buy it for a year out, then earnings might be disappointing given what Niël has said about growth concerns locally, growth concerns offshore. And then I think what one should not forget is that we're in amongst an inflation, don't want to call it a shock, that might be too dramatic, but an inflation hiking cycle or upward cycle in inflation. And if the Reserve Bank were to fight this inflation cycle, they would probably act aggressively by increasing interest rates aggressively so that we can open an interest rate differential between ourselves and the rest of the globe. so as to fight the inflation problem. So if that were to happen, one might see bad debts rising, so that's another concern for earnings going forward. And then the other concern is that banks make money by lending out the asset base they've got that they can work with. And in a slowing economy, you're not going to get a growing asset base. So the asset base would probably decline or stay stable, and therefore you might see some problems with earnings going forward. But as I said, a month ago, it was easy. If you look at it now, it might be a 50-50 call, but if you buy it for a 5-year, I'm still very comfortable with buying banks.
Niël, let's talk about the growth concerns that you mentioned in your previous answer. Looking at the likes of Capitec, they've got exposure to the unsecured lending market. And of course, we are seeing the growth concerns. And Arno was talking about inflation. And of course, it's going to constrain the consumer even more. So for a company like Capitec, as an example, is this something that you are definitely considering or being cautious on?
Look, to be honest, I'm actually quite confident in the management team and not concerned at all. They've recently just released a positive trading statement in tough economic conditions, being able to increase their earnings by another 20-odd%, so which is positive. They've been growing their client base. That's positive as well. But I think to answer the question on unsecured debt, the way their position is quite good. They've got a non-performing loans coverage of 200% and a capital adequacy ratio of over 30%, whereas according to Basel III, you need to have a minimum of 8%. So I think they're quite good positioned for the time ahead.
Just to get some closing comments from you, gentlemen, I have just about 2 minutes left of the program. Arno, let me come back to you in terms of positioning. I'm sure a lot of your clients are wanting to know where should we place our money, which sectors should we be invested in. If you look at banking relative to your other sectors, your industrials and so forth, is this a better sector to be in the longer term?
Yeah, to me, we got back from London last week, and a lot of the global managers are definitely adding bank exposure. I wouldn't say they're going overweight, but being underweight, probably moving to neutral weight, and that's probably what we are looking to do as well. It's not going overweight banks, but more or upweighting the underweight that we have been holding in banks. Yeah, so time will tell as if it's too late. But yeah, like I said, the focus is fairly on earnings going forward. But if you do it on a 5-year basis, you should be fine.
Niël, let's find out from you. What are you telling your clients?
Yeah, I mean, it's obvious that the bank sector is trading at very low multiples, and just looking at that offers value. But I think you need to come back to the macro factors. What are the factors that will make banks re-rate? I guess a big player will be whether we will be able to avoid a downgrade. That will be positive on the banks. And I think in the long run, you'll also want to see the commodity prices increase again and the demand coming through there. So I guess at this stage, rather be cautious and not run into them and maybe just hold at this stage.
Okay, don't cash in just yet. Gentlemen, thank you so much. Niël Hougaard, a fund analyst at Autus Fund Managers, and Arno Smit, Chief Investment Officer at Skyblue Fund Managers. Thank you so much for that, gentlemen. Of course, they were taking us through that banking landscape. That's it for this week's edition of Finweek Money Matters. But do remember that you can go and get yourself a copy of the magazine. It is available at your nearest store, or you can also look at all this content, and you can get it online. We'll see you again same time next week. Have a great weekend.